Thanks for joining us for another For Investors by Investors Long Beach podcast. As always, we're proud to be your all-education real estate resource without any kind of sales pitch. If you'd like to attend one of our meetings in person, we meet on the last Thursday of the month at the Grand in Long Beach, California. You can RSVP on forinvestorsbyinvestors.com/Long Beach. To find more investment resources such as blogs and podcasts and content from other FIBI groups, you can go to forinvestorsbyinvestors.com and search our entire library. Now, on to the podcast.
That being said, I'd like to go ahead and take a second and have the sponsors introduce themselves. Tonight is going to be all about tax and legal strategies, like I mentioned. So we have CPAs and a couple of different attorneys up here that specialize in different aspects of investing and planning for your future. So I'm going to go and let Matt start it off with. I'm just going to take the mic off because it's going to be too hard to go back and forth. We have one mic, so. It echoes, right? Everybody can hear okay right now?
Yeah.
Okay, perfect. So, Matt, can you give us a little overview of what you do, Matt?
Yeah. Hi, everyone. I'm Matt McFarland. I'm a director at Keystone CPA with my wife, Amanda, here. We are a boutique CPA firm where probably 90% of our clients do real estate, whether it's full-time real estate or, have the W-2 job and invest on the side. Started back at Deloitte & Touche, one of the big four accounting firms, kind of in their private client group, and got exposed to high net worth people who invested in real estate, and that's kind of where the light bulb went off, that this is kind of the place to make money and where we can help our clients and stuff. And so I left there, went to a small firm, and at some point we decided to start we started on the thing back in 2008. So it's good to be here, and hope we can answer a lot of questions tonight.
Hi, my name is Amanda. In addition to being CPAs, we're also real estate investors ourselves as well. We do mostly long-term home rentals, although, like he said, our clients, most of them are in real estate, flippers, note investors, rentals, kind of the whole gamut. So we're really excited to be here. I know someone asked earlier what we were going to talk about today. So it's kind of exciting because I'm not sure. It'll be up to Matt.
We're going to talk about whatever he wants to talk about.
Whatever his personal tax questions are, I think we're here to answer those. So thank you.
Thank you.
Hi, everybody. My name is Brian Chow, and this is my work wife, Peter Fisher. I am a California State Bar Certified Specialist in estate planning, trust, and probate law. What that translates to is I'm an attorney that focuses on estate planning and also asset protection planning. So helping clients as they accumulate wealth to structure their assets to make it more difficult for people to sue them, and ultimately to pass those assets on to their loved ones or to charity in a way that maximizes their legacy, is tax efficient, and thoughtfully helps to increase their family's long-term chances for success. And I also am a real estate investor, mostly buy and hold, actually exclusively buy and hold at this point. But I've been affiliated with FIBI for several years now, and it's just great always to be here and to learn more and to connect with other motivated people who are chasing the American dream. So,
thanks. And Peter has some bio and overview and things like that on the table here. It'll be at the back if you guys want to pick up his contact information. Any of the panelists here, if you guys email me, I'll get you guys their information, or definitely afterwards attack them and ask them for their cards for sure. So they will definitely help you. I've worked with Peter many times in the past, with some of my syndications. Brian will be my estate planning attorney if I ever get my crap to him in the first place, so if I don't keep changing entities and all this stuff. And I've actually sat down with Amanda and Matt a few times to be able to get the right consulting, because I do real estate full-time instead of the tax aspect, which they specialize in. So even I need that extra help sometimes to point me in the right direction and make sure that I'm not being stupid and thinking I know all the tax law that I don't know. So, Peter?
Good evening. I'm Peter Fisher. I'm a shareholder at a firm called Enenstein, Fan & Glass. My practice is transactional corporate and real estate. Most of my clients are small, mid-sized, large, multifamily, commercial developers, syndicators. My practice is sort of squarely at the cross-section of corporate securities and real estate, so I do a lot of private placements, crowdfunding, syndications, joint ventures, and the like, and happy to be here.
Thanks, Peter. Appreciate it. For those of you who don't know, my name is Matthew Owens. I am a California licensed CPA that is recovering CPA, sorry. But I don't do taxes anymore, and I love it. So I can actually go on spring break if I can get out of my own way and structure my business right so I can actually work less. But so I flip about 10 houses a month. We flipped over 600 houses in the last 10 years. We do a lot of value-add multifamily properties out of state. We own a management company and a renovation company and a real estate brokerage out in the Tennessee market and the Memphis market. I have a short-term rental business. I raise capital for syndications and invest in them in different ways, and also do some private lending out of state in different areas and sell different promissory notes and things like that. So it's a lot more fun than working at the tax. See, I'm going to pick on these guys the whole time, like just because
you have attorneys to pick on. What do you pick on us?
I was telling a joke earlier about how CPAs are way smarter than attorneys because it takes them 2 years to get their license when we can take the test. We're just way smarter. We can take the test, like that and get the license. So, but anyways, I'm sure I'll get that right back at me at some point. Yeah, exactly.
So you just went up, man.
Yeah, I know, right? Yeah, exactly. So all of a sudden, it's like the billing rate just creeped, So, but that being said, keep in mind, guys, this is a Q&A. Okay, so feel free to ask those questions if you're not clear on something or want to understand something. General or the more general, the better. Just because if it's a specific situation that may not relate to a lot of people, then we'll keep that and we'll let you know if that's too detailed for the discussion. So that being said, I have a list of questions that we can kind of go over as well to keep the conversation moving, but it'll go where everybody takes us. So first thing I would really want to understand and know, and I feel like a lot of business owners and small investors don't understand where the starting points are. If they're going to come, and I'm just going to relate to you two first, Matt and Amanda. If you have a prospective client, what are the major things they should have ready for you and that you want to be reviewing to be able to kind of advise them correctly and be able to give them a good understanding of some different strategies they may be able to implement? What do you need to see to start off with? How can they come to you prepared? Because so many people don't. I've had people bring me trash bags full of receipts before. I'm like, this is not cool, guys. So, but what do you think? Amanda? Sorry.
I guess from a planning perspective, one of the first things I always look at is prior year tax returns. So I see what kind of gives me a big picture of what they have going on. Another great thing is, as CPAs, we look at the numbers. So it's one thing to come and tell me, here's what I think I'm making. It's another thing to be more precise about how much you're actually making. That's kind of where we start. We look at everything from retirement account to W-2, just kind of get a holistic picture.
Yeah, I think we have a kind of a questionnaire that we have fill out or give to prospective clients to kind of with a laundry list of questions, but it's more to understand not only what's happened in the past, but what's going on right now. Or, we need to know if you're going out and buying a 10-unit apartment building and raising money from private investors, or forming these LLCs, or you've already formed them and didn't do something right. It's asking what are your goals, what are you looking to get help with, basically, so that we can help you with that holistic picture for sure.
And I think it's important to understand that when you're going to a CPA or an attorney, or a estate planning attorney, or a legal structuring attorney, I think it's important to understand that it's up to you first to come correct to them, to have all your stuff together, and I'm talking to 95% of you, the other 5%, have your stuff together, if it's 5% in the first place. And I'm telling you this from experience, from knowing other business owners that flip 10 houses a month plus that don't have their financials in order and are still killing it in different ways, but still are shady on that side of things because no one ever teaches you that stuff. Nobody ever teaches you the financial side of things, where, hey, if you were to come to your estate planning attorney, your legal structuring attorney, and your CPAs with the proper income that you've made, with all your books up to date, you'll save 10 times more money than just saying, hey, I think I made this year, and this is the type of income I made, and being general as a whole. So if you come correct and have your books updated every single week or every month, and have everything taken care of, and you know what your budget is and what your goals are, as far as cash flow planning goes, you're above and beyond being able to, as far as everyone else goes, and being able to actually get the proper help that you need from the experts that know what they're doing. So I think it's really important to start off there before you ever go even try to get advice. Get your stuff in order first, and if you don't know how to get your stuff in order, ask for that help for sure. So Brian, can you kind of answer the same type of question from an estate planning approach? When you have a new client come to you, what are the different major concerns that you're looking at from, and it's hard because it's all across the board, of course. I can't just say a normal person. Everyone's different, right?
Sure.
So
everyone says that they're normal.
Yeah,
I'm normal. Everything's good. It's simple and it's fine. Yeah,
right.
It'll be fine. Well, I will say thank God for the 95% that don't have their stuff together. Okay, so when I have a client or a prospect come in, I also have a questionnaire, but what I'm trying to get a sense of is what is this client's family situation look like? Are they married? Do they have kids? Is it a second marriage? Do they have children from prior marriages? Are the kids healthy? Is there someone in the family that maybe has special needs that we need to be aware of? Things like that. And then we're also trying to get a sense of their financial picture. So if you think kind of big picture, net worth statement, an understanding of what their assets are. Do they have a house? Do they have multiple rental properties? Do they have a business? Are they a W-2 employee? Do they have other investments, 401k, things like that? So, and getting an understanding of how those assets are currently situated, right? We want a snapshot of what assets do they currently have so that we can figure out, okay, what are the things that we're planning for? Because when we're talking about estate planning, we're really talking about control. What happens if something unexpected happens to you or your wife or your loved ones? How do we make sure that in the event that you either die or become incapacitated, that we have the proper mechanisms in place to carry out what you want to happen? And then also, knowing that what assets people have, then we want to understand where the liability points, right? If you have multiple properties, what happens if there's a slip and fall on the property? Where can that liability go? Can it attach to your primary residence? Can it attach to your brokerage account at Fidelity, right? And then how do you, knowing where all the liability points are, then we can start planning for, okay, how do we place these firewalls between our assets and our liabilities to make it as difficult as possible for creditors to come after your stuff?
Okay, cool. So the different pieces of a proper estate plan, you're dealing with the tax aspect, the legal aspect of things as far as asset protection, the investments aspect of things, as well as proper planning for your estate to be able to pass on those assets as well, right? Is there insurance and risk mitigation? Is there anything else that I'm missing here besides those major items there?
Those are the main
ones. So it's all encompassing, almost like a financial planning person that's sitting down with you to go over your entire aspect of things, right? So and incorporating the estate plan into it as well. Okay, interesting. Peter, what about yourself? When you're sitting down with a prospective client that is, interested in going into business for themselves or has, real estate that they're looking at investing in, what are the main things that you're looking at when you're trying to advise them on, I guess entity structuring or, and I guess we could touch on a couple of different topics here, initial entity structuring for rental property, for example, right? So what are the different factors that go into, your advice on what type of entity and, how to structure it?
So we have a questionnaire too. We all have questionnaires. The first question is, what are you trying to accomplish? And so we try to, through a questionnaire, through conversation, just take in, what are you trying to do? Where are you buying this property? Who are you buying it with? Are you doing it yourself? Do you have partners? Are you taking other people's money? How would you like the control of this entity to work? Are you a manager and you're just taking people's money passively? Are you sharing control with somebody? How do you want the transfer provisions for your entity to work? And then sort of what is your business? And that will help us determine how to structure your entity and sort of what the right type of entity is, along with where your property is and where your investors, if you have any, are, and sort of jurisdictionally, where should your entity be? And we often ask who has advised you, who are your other advisors? Do you have the right CPA? Do you have, who drafted this trust document that you're trying to have as this general partner of your limited partnership, and why are you doing that? So those are sort of the questions. And there's a long questionnaire, but it gets at all of these things. It makes the potential client think about, I never thought about, what happens if I pass away? Who gets, my interest in this apartment building? Does it get transferred? What if I get divorced? Do my other partners become partners with my ex-wife? How does all of that work?
And there's a ton of misinformation out there about legal structuring. Of course, who here has been told that they need an LLC to invest in real estate? Okay, so from my understanding, you should not be going and necessarily just opening an LLC before you have a property under contract in the first place. And I know a lot of people that have went and opened LLCs up or S corporations up and different entities up before they even have anything, and they start wasting their money, on $800 California fees and reporting requirements and tax returns and things like that, which can cost a lot of money, especially if you're starting out. You're looking at $800 fee, a couple $1,000 tax return, in most cases, depending if it's a zero return or if there's how much activity it is. You have, the compliance issues with the state and things like that to deal with. There's a lot that goes into that. It could cost you a couple $1,000s a year just to run an LLC in the first place. So if you don't have an asset, why are you setting this up in the first place? And and it also depends on how much money you're making. If you buy one rental property that's making you $300 a month, does it make sense to go through and set up an LLC in the first place? And what is the purpose of doing that? Matt, when you actually are helping a client set up, an entity for a rental property, what are the reasons why they do that for tax purposes? Is there any benefit of putting a property in an LLC for tax purposes in the first place?
Yeah, it's a good question. For tax purposes, assuming it's it's a long-term hold rental property, there's actually no tax benefit to having the property owned by an LLC. So we always defer to that question. It's you would do this potentially for asset protection reasons, and you should speak to your attorney about it. So for tax purposes, you're going to get the same deductions as if you own it personally. If you own it by the LLC, it's going to have the same numbers going to get reported on your personal tax return, assuming you're the one who owns the LLC. So yeah, there's not really any reason.
Hey, Matt?
Yes.
What if you elected to have a taxable corporation, an S corp or a C corp? Are there any benefits to doing that?
Yeah, I mean, there are situations where obviously, depending on the type of real estate, you may want to own real estate in a corporation like an S corp or something. For a lot of our clients, we see that when they're flipping properties. But strictly long-term holds, we don't like to see those for tax purposes, at least inside corporations. But yeah, there can be tax benefits of doing things depending on the type of business you're running and stuff.
I think one of the biggest misconceptions that we hear, from real estate events or just amongst real estate investors is that you need to have an LLC in order to take certain deductions. So, in order to take a deduction for your membership here or your drive to another club, you have to have an LLC in order to take the deduction. And that is actually incorrect information. Okay, when you talk to a CPA, when you talk to a tax advisor, a lot of times they'll say, well, this is a business deduction, right? We refer to it as a business deduction, and so people interpret that to mean, business, they're talking about an LLC or a corporation. But in reality, when we say the word business in the IRS's context, it's really just in the business of owning rental real estate or flipping real estate. So more than 90% of the tax deductions you hear about, home office, car expenses, paying your kids, writing off your computers and cell phones and all that, most of those are deductible whether you have an LLC or it's in your individual name or inside of a corporation. For your question specifically for rental real estate, for most of our clients, the only reason to form those would be for asset protection purposes. I know earlier we talked about we all have our own questionnaire, right? And a lot of times there's sharing. We work with a lot of attorneys. They find our questionnaire helpful. or we find their questionnaire helpful, because we're all trying to figure out a lot of the same thing, which you can probably imagine is the comprehensive nature of what you have going on. And so it's very common when a client asks us about LLCs for rental, we'll say, who's your attorney, right? Who's your attorney? Where are they recommending? And we compare that against what's the cost that Matt Owens was talking about. What is the cost in California? How many entities? And we arrive at a good ground for what makes the most sense.
And I'll come back to you, Brian. But Peter, when you're dealing with a typical client, if you're dealing with a client that has rental properties in their name, and say they have a couple of rental properties versus 50, okay? So they have a couple of rental properties and they're a high net worth client. What are the primary reasons to put it in the LLC in the first place? Because there is that cost involved, right? What are they getting for paying that cost of setting up the entity in the first place?
Yeah, so there's a couple of main purposes for entity formation, putting aside anything tax related. The main one obviously is liability protection. You're protecting both what's inside that entity, inside that LLC, but you're also protecting what's outside of it. So if you have lots of other businesses, lots of personal net worth, and you buy an apartment building, you don't want something that happens, a slip and fall, or
marijuana growth,
In-N-Out burger in your building, anything, to happen that will then affect your, potentially have that issue reach your personal assets. So you would want an LLC, maybe even another entity that would be the manager, the property manager of that entity, so that if somebody came after that entity or there was a claim, an insurance claim, it would only affect the assets of that particular entity. Maybe they'd go after the property manager, the manager of the LLC, who potentially, depending on the scale of the property, you would want other entities. But again, you can handle that kind of thing with insurance and other ways. So a lot of times, you might be advised to form too many entities. So, I try not to say it depends, but it depends on the situation.
It's always it depends. That's a lawyer.
Question.
Oh, yeah, back to the tax benefit of the LLC. I just got out of one that had a lot of different partners. We're not all married. We're not Mormons. Multifamily. Pardon the pun. But is there a difference between an LLC that's owned by a family, let's say husband and wife, or one managing member that's also the member, versus tax situation for many partners?
There could be, obviously, yeah. It's going to depend on how what the agreement is in terms of sharing, revenue and expenses, and because in certain situations you can specially allocate things to certain partners, and maybe there are situations where.
Let's say we had an LLC with a family, and the patriarch of the family is the managing member, and all the kids and everybody else, and you have the same exact parallel thing with just parent people that aren't of the same family, but the agreement's exactly the same. Is there any?
Not like straight income tax purposes, probably not. But again, we like to say it depends too. But
I think, if your question is, do I get more deductions if my LLC is owned by unrelated parties versus my family in terms of what is the net taxable income to everyone collectively? The answer is no.
Yeah,
okay.
I'm looking for something other than the CPAs, not under my direction if I'm the patriarch of my family's LLC versus partnership where I might not be the managing member. The managing member tends to pick the bookkeeper and person that when the thing gets liquidated, they're going to do the math. My guy doesn't get to do the math. Besides that, or is there anything else? Because I just experienced that one.
It depends on who your CPA is.
Extra call of money to throw into it after we thought it was all settled.
Right. If you're a passive investor in a syndication deal where you're one of 50 investors, yes, odds are that you don't get to determine what's the tax strategy for that LLC, how's income allocated, are we doing cost segregation, right, naturally, if you're not the managing member. If you're the patriarch, then that is a benefit, right? Just like if you own the real estate just with you and your wife or you and your kids, a lot more control than if you're a passive minority investor in someone else's syndication. But going back to income tax, no, it's the same. Same deductions, same taxes. You don't get any more deduction just because of who's part of the member who's managing it.
Right, that's more of a legal type structuring on the entity. Question in the back here.
Different thresholds across different asset classes that dictate the type of, let's say, entity you use. For example, you have a single family home versus an apartment versus commercial versus home.
I would say it depends on the amount of equity that is in that asset, and it depends on the amount of income the asset is throwing off,
the amount of liability,
and the amount of liability, and it depends on what's outside. So I don't think it's necessarily, a multifamily, you need this entity, or single family. I tell the story all the time. I had a client who had 4 multifamily properties here in Long Beach. She had them all in her personal name. She had great insurance. She had the most extensive tenant screening process I've ever seen. She had a couple issues, but sold all her properties and moved to Mexico. I wouldn't have necessarily recommended it, but she didn't want to pay for the LCs. She, had lots of experience. Her tenants were, checked certain boxes for her, and it worked. So, in that sense, she didn't need, 4 entities with 4 other entities being the managers of those entities. And, whereas if you have a 250 unit apartment building with, a third party property manager, and I don't think you want to own that in your personal name.
I mean, it's a matter of what your exposure is.
Yeah.
Right? On a single family home, you have 1 tenant, right? A multifamily, you could have 30 or 40 or however many units you have,
right,
times how many people in that unit too. And so, there's just a lot more exposure.
Yeah. You could own a $15 million home in Malibu with a pool and all, shrubs and stuff, and you don't want to own that in your personal name. Where you could own, a small house in Palmdale that's a small rental, and your income per year may be more than your LLC fees.
So I guess going back to the threshold question is there somewhat of a kind of a bright line test for maybe individuals or families that, let's say their net worth is...
It totally depends on your situation.
Yeah, it's really your own risk tolerance level, right? So
what's gonna let you sleep at night, right?
Right. So, and in addition to that, if you could own a property in your own name, a single family home that has $20,000 of equity in it or something like that, so you would think normally, hey, and maybe you're not that high net worth, and so you don't need, you may think, hey, insurance is okay, what are they going to get from me? But at the same time, you might have some exposure from, them suing you and garnishing your wages or something like that, if there's some negligence.
Or you could talk to this guy and have all of your assets offshore somewhere, and then you're like, come sue me, I can have 12 properties in my...
And that kind of leads back to the trust question when you're dealing with estate planning. A lot of people, if they have a rental property in their own name and you're helping them set up a trust for estate planning purposes, how does that work when they're transferring the ownership of the property to the trust, and is the trust exposed? How do you protect the trust, and who's on the hook for liability in that case?
Yeah. Okay. So in doing estate planning, everyone here familiar with what a living trust? Have you heard the term living trust before? Anybody not heard of that term? People are being shy.
They're lying. They're all lying right now.
Okay, so from a planning standpoint, a living trust is one mechanism that people use in estate planning. And so this is, again, a way for you to create an entity, like an LLC, but different. It's a separate entity. And what you do is you transfer ownership of your assets to this entity, and essentially it's a management entity, right? So we have this living trust that owns a bunch of stuff, your house, your bank accounts, your investments, and usually you're going to appoint yourself the trustee of the trust. So you're the manager, you get to control it. The benefit is during your lifetime you can do whatever you want with the assets, but if you become incapacitated or if you pass away, right, you may have passed away, but you don't own everything in your name, right? So everything's held by this entity, and the entity says, okay, if you're not around, then your vice president or your successor steps into your place. So let's say I appoint Matt as my vice president. He can now step in, he can manage things. So, and then Matt can then carry out my wishes. So if I say, hey, my house goes to my son, Matt now has the legal authority to sign all the documents on behalf of my trust to transfer the name to my son. Whereas had I owned it in my own name and I passed away, I would not be around to dictate where my stuff goes. So then all of those assets now have to go to court, and we end up in what's called probate. So the state of California would then just take control of my assets and try to figure out where everything is supposed to go, which is not necessarily ideal for a whole host of reasons. Now, going back to asset protection. So what happens is a lot of times people assume, hey, if I put assets into my living trust, right, I've transferred ownership of my house, my rental properties, my LLCs into this living trust, I no longer own it, right? It's held by this separate entity. So if I get into a car accident or somebody sues me, I can now say to a judge, hey, I don't own any of this stuff, so it shouldn't be subject to my liability. So this is something that's very important, because a lot of you who have living trust may have thought this before. But a revocable living trust, so your standard everyday living trust, does nothing for you from an asset protection standpoint. And the reason why is because your trust is revocable, which means that you retain the right to change your trust however you want during the course of your lifetime, including completely getting rid of it. So you can blow up your trust, take your ball, and go home, right? So if you blow up your trust, everything comes back into your name and is now subject to your creditors. So if you have a living trust and you try to make that argument to a judge, the judge is going to say, well, it's a revocable trust. We're now going to order you to blow up your trust. Everything comes back into your name and you can now go pay your creditors. So having a living trust does not make an asset protection plan, right? It's really good for succession planning, but that's why we need things like LLCs or irrevocable trusts or corporations or different types of other entities that really create that backdrop for shaping the way that liability flows between your assets.
So if you have all of your stuff inside a trust, basically not only can they go after you, but they can go after everything inside your trust as well, because you technically own your trust, because you can actually go through and just revoke it anytime, right? So anytime you want, meaning you don't technically own it because the trust owns it, but you can take that away at any time. So therefore, any liability, like if you have a rental property inside the trust, whoever sues you on that rental property could get anything else inside the trust, and possibly your own personal assets as well if you have them outside of the trust. Does that sound right?
That's correct. So the trust does not make you any better off from an asset protection standpoint.
So what you would recommend in that kind of a situation would be something where you have, if you want to put asset protection in place, you would have an LLC that owns the rental property and have the trust own the LLC to then protect everything outside of that LLC. Does that sound right?
That would be one mechanism, okay. Right? So if we wanted to have an LLC to lock up that liability for that rental property, right? The LLC would own the rental property, and then the trust would then be the member of that LLC. So,
okay, and then you could still be the signer of the LLC as a manager of it and have complete control and things like that, right? So, okay. Question here.
For properties in multiple states, can it be consolidated in one LLC? Does that just make it that much more difficult for taxes if there's 4 single families in Illinois, a house in Wisconsin, and a duplex in Compton, structuring that so there's less entities to pay for to Jerry Brown, but does that protect you any better?
Yeah, I mean, it's a common question too. It's a good question. From a tax perspective, generally speaking, when you have rental properties in other states, you may be required to file state tax returns in those other states. So now that could be whether you have the LLC owning the property or you own it personally. Now, from a simplicity perspective, from a tax perspective, if you have one LLC owning multiple properties in multiple states, that's probably less tax returns than if you had 5 LLCs owning properties in all those states. So it's going to, that's kind of from a tax perspective. Now, from a estate planning or asset protection, that's kind of one of those things we have to defer to them, because each state, I think, my understanding, each state is a little different in terms of benefits.
So if it's a California-based LLC, is that operating agreement still legal if it was something happened in Illinois or in someone else's?
Yeah, I mean, so to clarify, just because you file tax returns in 5 different states doesn't mean, for example, you could theoretically have a property in Illinois that is owned by a California LLC. You would probably have to almost certainly have to register that LLC and get it foreign qualified in Illinois as well.
And if you don't, what happens?
If you don't, and I'm not a lawyer in Illinois, but if you were operating a business in California and you're not qualified in California, that could subject you to penalties, and you could, for example, not be able to enter into a contract in California because you're not a registered entity in California.
Like a loan. I've done that one.
Yeah.
We had to get it registered to get the loan done.
Yeah. Now, we have many clients who operate in Indiana, buying properties in Colorado, and I'm talking about in this case, large 200, 300 unit apartment buildings. They are almost exclusively formed in LLCs in Delaware. And there are specific reasons for that, which I don't know if we want to go into, but so the point is you can have an LLC that is formed in one jurisdiction that owns property in another jurisdiction, and for tax reasons and operating reasons it would qualify there, but you could, and that one could own 5 different properties in other places as well. So it's possible, but again, it depends on what those properties are, what they're doing, whether you want the liability for 5 different properties to potentially, do they have different investors? So
I think it's important to understand as well when you're doing that structure and have an LLC, a California LLC that you're going to go and register in other states because you're going to buy properties in multiple states and things like that, you have to really understand the tax implications in those states.
Yeah.
So to give you an example, in Tennessee, specifically where I invest, if you own property in an LLC, there's a franchise and excise tax of 6%. If you own it in your own name, there's no franchise, there's no income taxes. If you have a LLC that's 95% family owned, that's opened in Tennessee, which means if I live here, I have to register it here anyways and pay my $800, but it's a Tennessee LLC that was formed in Tennessee and it's 95% family owned and owns residential property, then I can qualify for what's called the fonts exemption and not pay that excise tax, and I can still get my liability protection and things like that. So there's little intricacies in each state.
Every county, too.
Yeah, you got to be really careful, with all these different things to make sure that you're doing it right and understanding or talking with a CPA that at least understands or can research for you those state laws in those specific states for tax purposes, because they can change. And California, what's their stance about Nevada LLCs? And not registering here again?
Well, California's rule is that any entity that's ultimately owned or managed by a California resident would be subject to the $800 fee. And so an example of that would be if I owned a rental property in Nevada, I formed a Nevada entity, naturally you think, well, I don't have to pay the $800 fee because my property's not here, my LLC's not here.
You're not doing business in California.
Right. But California's rule is that, or their interpretation of the law is that because I am the ultimate owner of the LLC, of course, I'm doing business from my home in California. So 9 times out of 10, if you're a California resident, any legal entities you have, the Franchise Tax Board would want you to pay and register in California. In the past, if you don't and they catch you, you pay back the old taxes and there's a $200 fine on top of it. So a lot of people would take that risk and say, okay, fine, I'll kind of try to stay under the radar. If they catch me, so be it. About a year and a half or 2 years ago, they changed that. So now the new penalty is that once they catch you, you have 60 days to pay the old taxes, file the old tax returns. After the 60 days, the new penalty is now $2,000 per year per entity. Okay. So they're really cracking down on that.
Is there case law on this as well already with regard to people that fought this, or because I would assume you got to go against the government, but
there was only one case so far that it was a big syndication. It was a little bit of a different scenario. It was a syndication with an out-of-state investor who sued California because California wanted the out-of-state investor to register and pay here.
The out-of-state investor was an LLC, so they used their LLC for their investments. They, invested cash. They had zero management decisions, not making any decisions whatsoever.
Most, if not all of our clients, if they get caught with those penalties, they will generally pay because the alternative is to hire an attorney, like one of these folks here, and that might not necessarily be cheaper than just paying the tax. Okay.
Might 2 hours.
And so what I always tell people is that if you're someone who has a bunch of entities, you've had them for years, definitely talk to your attorney. Maybe it makes sense to get rid of those entities and start fresh and be in compliance. Or if you just kind of want to close your eyes and not think about it, at least make sure that your registered agents have your most recent forwarding address, because that's the time when we see the most issues. Is they might have formed a Nevada, hired a Nevada attorney to form an entity 10 years ago. They decided to stop paying them to be their registered agent, and now who knows where those California notices are going? And a lot of times you don't know until you go and sell the property.
So if you get one of those letters, don't just put it in the drawer.
Don't shred it.
That 60-day window is probably already started like 2 weeks before you got the letter.
And don't wait 55 days to go talk to the CPA to go get it done, because that happens all the time, for sure. So,
And by the way, as an aside, if you are owning property anywhere or doing anything outside of California, don't form a California LLC.
Yeah.
And even if you're doing business in California, you may not want to form a California LLC, just because there's a new California LLC Act and it sucks. And if you want more information about that,
can you touch on it just briefly? What are the
what
are the main sucky points about it?
Last year, they revised it's called the Revised Uniform California LLC Act or something, and they were trying to make things more streamlined. And people generally, large corporations, Apple, they're all formed in Delaware, and then Nevada kind of tried to be the Delaware of the West. So California tried to get in on the act, and they tried to revise their LLC Act. But for things like fiduciary duties, things like now there's this new word, dissociation, which is kind of when a member can get expelled. There's all kinds of rules that are not good for you as the manager, controlling member of the LLC. There's a lot of default rules that don't make sense. And we can, you could talk to me offline and I can send you an overview of it. But it's not, for example, if you're forming a manager-managed LLC and you're bringing in investors, we would almost always recommend you form that in Delaware or somewhere else, even if it means qualifying in California.
And that Delaware LLC is because why?
Delaware the LLC Act is very streamlined. You can remove your fiduciary duties. All the courts in Delaware are very familiar with corporate and real estate law. There's lots of reasons, but those are some of them.
Okay. Question here?
Yes. So for asset protection purpose, which one is better? Well, I know you have to pay California fee if you're a resident, but create the California LLC, then go to maybe Nevada, and then to own that Nevada LLC, buy California LLC, or just get the permit to
Okay.
be
So
outside.
the question is, for asset protection purposes, what venues should you choose when forming an LLC? Is that the question?
No, my question is California LLC, if you own outside of state property, is it better to get qualified outside of state?
Oh, okay.
You're saying
okay.
register it there or start one there?
Another LLC owned by California LLC.
So
I would say
the or is no. So
I don't think you would choose if you don't have to. You probably wouldn't choose a California LLC to be the entity, right? You would probably choose. So let's say you were buying a property in Nevada, right? I mean, any state is probably going to have friendlier LLC laws than California. So, to Peter's point, Delaware, certain states will compete for business. They want to be business friendly. They want business owners, landlords to do business in those states. So Delaware and Nevada are probably the two most aggressive. So they tend to be the most asset protection friendly or debtor friendly states. So so you might open up a Nevada LLC and hold the real estate in Nevada, But because you're a California resident, right, if you're managing the property, especially the franchise tax board, will their take on it is, hey, you owe us $800. It needs to be duly registered here in California as well.
Just because you live here and they say you're managing it here.
Yeah. So,
but that doesn't mean organized here. So you can organize, you can form your LLC in Nevada,
Okay.
and then you can qualify it in California, but it will theoretically still be governed internally, like the member fighting the manager or in Nevada. Now, California wants to get its hands on everything, and there's some cases in case law where California has tried to say, well, but this is happening in California, and you know, I don't even know. California has tried to encroach on the internal workings of LLCs in other states.
Okay, so if you create a LLC in Nevada and if you live here, you either way you have to pay $800 to the California.
you don't have to, but you might be subject to penalties.
Yeah, I mean, the less contact points so if you're operating an apartment building in Nevada, you will want to get a bank account where all the rents go in Nevada. You might want a property management company that manages the property in Nevada, and you can just say, I might own it, but I'm not doing anything, you know. But California will try to say, nope, you're still here. Ultimately, the money goes from the bank account in Nevada. It's coming back to you, right? I mean, you know, so.
Just think of California as the ultimate tyrannical government that's trying to take all your money and steal from you. So.
It's $800, right?
Yeah.
So registered in California, the Nevada LLC, or the Nevada LLC with California LLC, it's the same fee, right?
No.
Which is there for protect assets.
Like in the situation that you set forth, I would say probably a Nevada LLC registered to do business in California. If you just want to be safe from a tax perspective, you would not form a California LLC and then register to do business.
It's a nominal fee to get that Nevada LLC registered in California, I assume. It's not like
The registration is not expensive, but then you got to pay the franchise.
I did that with the Delaware to get that loan done.
Yeah.
Now there's another level. You could have the managing member of the Nevada LLC as the California LLC. I don't think that's what she was bringing up. So
you could. I mean,
but I can't think of a reason why you would at this point. Because
I've seen that once before the Texas thing for some reason.
it might be for liability if you had like multiple investors in the underlying LLC.
Yeah.
Maybe, but
or a bunch of different types of assets, all that flow up or something like that. But
another point that to touch on too is, you know, when deciding whether or not you are going to register for an LLC in California may also depend on the tax ramifications. So, for instance, and you guys correct me if I'm wrong, but if you're taxing it as if it's a single member LLC and it's being taxed as a disregarded entity, there is no separate tax return, you know, filed for the state. Everything's or filed federally. It's just going to flow through to your 1040. So it's just going to get reported on your Schedule E. It's not likely that the franchise tax board would find out about it from the federal government. So that's another consideration to kind of play with.
So you could enjoy the state tax situation in the LLC out of state, deal with your California state tax, and your Fed thing's already taken care of from.
Yeah, just because in a single member LLC, it's a flow-through entity and you don't do a separate federal tax return. So
right.
The way that the state of California knows about it in the first place is you get a K-1 that you then, from that LLC, that reports to your individual return. But in a single member LLC format, you don't typically get that. You report it directly on your personal tax return.
Yeah, so they wouldn't know that you were operating an LLC out of state. It would just look like you owned property out of state.
And that kind of brings up, like... We're talking about, LLCs for rental properties and things like that. What about, from a tax standpoint, what about, a business owner that's flipping properties and say you have just give two different examples of how you might structure something from a tax perspective, what the reasons would be for a flipper that maybe does a couple of houses a year versus a flipper that does 100 houses a year. or does a ton of these things. What kind of entity structuring might you guys recommend from those different standpoints, and what's kind of the difference between, the two types of income?
Well, I think just from a simplistic perspective, you say you're flipping a couple properties a year, you're doing your personal name, that income is generally going to be reported on a Schedule C. It's a sole proprietor business. That's the type of income that you're obviously paying federal income taxes on, state income taxes, but it's also subject to self-employment taxes. So, which is basically, you're working as a W-2 person, you're paying payroll taxes, right? Social Security, Medicare. You pay half of it, your employer pays half of it. But if you have your own business flipping a property, you're paying the whole thing. It could be another 15% on top of your federal and state income taxes.
That's if it's a business, right? If it's just a one or two flips a year, is it considered short-term capital gains?
Well, so you could take that position if you're flipping a couple properties a year, show them as capital gains income where it's not a business per se. Kind of depends on your facts and circumstances, your intent going in and facts and all that stuff. But yeah, that can work. But if you are truly flipping properties, that's your profit's going to be subject to self-employment tax. So situations like that, very common examples. We talk to clients about flipping properties through an S corporation. It's a very common, typical strategy. As it currently stands with tax law, things may change, and I'm sure we're going to get into that later. But that's a way that you can at least minimize some of the hit on the self-employment tax.
So why does it do that on S corps? How does that work when you're dealing with S corps?
The benefit of the S corporation is that the IRS allows you to use what's called a salary versus dividend strategy. Okay, which means that if the company makes $100,000 of profit, you don't have to pay self-employment taxes on the whole thing. You only pay payroll tax, which is the equivalent of self-employment tax on whatever you take out as W-2s. So, just assuming the person who's doing the flip doesn't have any other sort of W-2 income, that's all they're doing. Generally, on $100,000 of net profit in an S corp, you're looking at saving anywhere from $3,000 to $7,000 in terms of self-employment taxes. Okay. Of course, just like legal stuff, tax answer, a lot of it is all as well. It depends, because if you're someone who's flipping, but also you have a W-2 job, or you have another business, or you get another W-2, an S corp may or may not be the best for you to do your flip or wholesale income in. So, from a planning perspective, we were saying earlier, it's really important to talk to your CPA or tax advisor about, not just what you did last year, but also what are you planning on doing? How much profit are we making? Because for someone who's flipping and making $30,000 profit, we might recommend a different entity than someone who's making $100,000 profit. Right? We don't care if it's, $5,000, $10,000 off. That's not a big deal, but it is a difference from a strategy perspective, 40 versus 100.
And so if you're looking at, we're talking about active versus passive income. Active income on a lot of this stuff is subject to self-employment tax, which is 15%. So if you're flipping a bunch of houses in your own name and it's considered active ordinary income to you, then you're looking at paying 15% on the net income as far as your tax goes for payroll taxes, right? For FUTA, FICA, and Social Security, aka Ponzi scheme. But I'll get away from my politics in a second. But anyway, but when it comes down to that aspect, if you put it into an S corporation, like you said, you get that salary dividend split where you can take off a big chunk of that 15% payroll taxes and not have to pay it, because it can be a big portion of that can be considered dividends, right? And so when you're dealing with that, there's also what's called the required minimum salary. So if you made $50,000 inside your S corporation and you that's all you made in your S corp, but you're a realtor or something like that, or a flipper, you want to look at what the average salary is in that area, and there's like that minimum salary per person that you still have to pay the payroll taxes on. How do you guys determine that, minimum salary? Is there a general rule or a IRS table that says realtors make this much, CPAs make this much, type of deal? Or what kind of guidelines can you use? Is there anything? Is it just
I
subjective?
mean, it depends on what the business owner is doing. So I think it's a vast difference if you have a flipping company and you're the only person working in it. Okay, generally that's higher salary than if you have a flipping company and you have a lot of people working in there with you. You're kind of just a decision maker. That justifies a lower salary. We also have our clients look at BLS.gov, Bureau of Labor Statistics, because in an IRS audit they do rely on that. That is, published by the government in terms of, I don't know about a realtor example, but if you're a realtor in Orange County with this number of years of experience, statistically, according to the government, this is kind of the salary range. So they'll look at that too. But it is a facts and circumstances, what exactly is it that you're doing, particularly for the business.
The other thing to consider from an asset protection standpoint is you may not want to pay yourself the absolute minimum salary that you can justify, because if somebody does sue you, right, your LLC, if we structure it correctly, or your entity, will make it difficult for a creditor to just come in and take your stuff. But what they might try to do is they might just try to sit on you and essentially starve you out, right? Because what happens is if you're making distributions or if you're pulling money out, then the creditor would be exposed in many cases to the creditor's claim. So they'll just say, we're going to sit on you until you give us money, right? So if you're getting paid a salary, that's one way for you to get money out of your LLC. A portion of that would still be subject to a creditor's claim, but at least that way you can put food on the table and maintain some sort of a lifestyle. But if you're paying yourself the absolute minimum, you kind of look at it like a little bit of insurance planning. You're giving yourself a little bit of an out just in case something really bad happens.
Could you not just switch entities and start doing business out of a different entity and say this one doesn't have anything anymore? If one of those evil attorneys want to sit on you like that, or the creditor,
you still got to get money from somewhere personally.
Well, right. So so you're talking about if they sue you personally, basically.
Yeah. So you're getting sued for exactly.
I got you. Okay, that makes sense. Okay.
I was going to say the other thing to piggyback off that is another thing in play is retirement planning, right? So maybe you're running a business and we're trying to minimize self-employment tax, but at the same time you're also trying to put away as much as possible to a retirement account. And sometimes those two goals don't go hand in hand. So that's, it's not as simple as just paying yourself the minimum salary. There's a lot of things at play that you have to talk to your advisors about. All of your entire advisor team.
Yeah, you can do a matching contribution into your own 401k for 25% of your salary in a lot of cases for a company matching contribution, which can be huge. And so if you pay yourself a very low salary, that matching is much less versus paying the higher salary, taking the 15% hit on that so that you don't have to pay the 40-50% federal and state income tax on those cases. So question over here.
Yeah, with all about tax reform, do you guys think we should do anything different from a protection standpoint?
It's a loaded and open-ended question.
It's all speculative right now.
The answer is it depends.
Yeah.
I think we don't
call your president.
Tweet your president.
Yeah, I think it doesn't look like anything's going to pass for 2017. Of course it could, but odds of something actually being passed and being retroactive to all of 17 is not likely to happen. It's very possible that there might be major changes in 2018, which is good because then they'll give us quite a bit of time to do some more planning. I think one of the biggest proposed changes is the new entity tax rate of 20% for C corporations and 25% for LLCs, S corps, and even sole proprietorships. So depending on what your personal tax rate is at this point in time, it may be a good idea to look at forming a legal entity to get the lower tax rate for next year. But there's a couple caveats in terms of who within the business segment can qualify for that 25% tax rate. Currently, as it stands, the law defines eligible people as businesses who are in the sale of goods and not services. So if you're someone who's a realtor or a lender, that's in the service side, at least based on the current proposal, you would not be eligible for the lower 25% tax rate, even if you operated through a legal entity. But it looks like for those who are in fix and flip, wholesale, those are more sales-oriented businesses, you may be eligible for the 25%, whether it's a sole proprietor or an LLC or a partnership.
So it'd be better to go through and basically give people a bunch of tax and legal advice and then say, that's free, but here's a pin for $25,000, right here. So
here's some marijuana.
And I think they'll make the law more complex too, right? Because you have people who are in the construction business. How much of that is sales versus how much of that is services, right? Some of them is services, but a lot of that, they might be doing physical sales too. So it might just be more record keeping in terms of a business having to split out. If you sold machines, okay, well, you're going to have services income for the warranty, and then you have machine sales, and they might be taxed at different rates. But that's just based on the proposal as it stands today. Once we get the final one, it might be completely different. So
it probably will be completely different.
Yeah.
There's things that I'm it's just all rumbling at this point. Nobody knows what's really going to pass, but they're talking about taking away the increasing the standard deduction, but also taking away the property tax deduction or the mortgage interest deduction, which I doubt they'll take that away because there's a huge lobby. But we'll see what happens. But for example, people have told me a few times, hey, maybe you want to pay your property taxes in 2017 this year, so you take the deduction now. Even so that you can actually take that deduction if it may not be available next year. But then again, you may be doing that for no reason either, So you don't know if that's really going to pass or not. It's all speculation at this point. There's talks about the estate, taxes going away and stuff like that, which will change the game completely, for estate planning and there's still major issues with that too because now you may not get a step up in basis when you pass away now for estate planning purposes and stuff like that if they get rid of the
depending on your asset level, one's better than the other.
Right. So it's like which you don't really know until it's passed, and then you got to do everything you can to plan for it. So who had a question in the back? I just saw a hand up. Yeah.
I'm sorry. I think you said 20. The proposal is 20% for C corp, 25 for LLC. How about for S corp?
25% for LLCs, S corps, partnerships, and sole proprietorships.
So then that means the income wouldn't flow through to the individual level anymore. Then, in that case,
that's yet to be determined. It could be at the entity level, or it could just flow through and be taxed at a different rate on the personal, like how capital gains is currently.
Okay. Interesting.
So that's undecided. What they haven't mentioned anything about different taxes. So the lower tax rate again for sale of goods type of businesses. Haven't mentioned anything about investment income like rental income or interest income. So we don't know if that's something eligible for the lower rate or that's going to just remain at the current individual rate.
Right now is the corporate tax rate mirroring the personal tax rate? What's going on? I don't know how corporation is taxed.
Corporate tax rate does have a slight graduated scale. It starts at a low 15%, but it goes up from there very quickly. So I don't have the numbers off the top of my head, but very quickly C corporations can be paying 35% taxes across the board.
And maximum tax for individuals in the United States is 38% now, or 40%?
Highest federal income tax rate now is 39.6.
Okay, slightly higher
than
than
other things.
Yeah, so another unknown we don't know is the lower C corp rate and flow through entity at 20-25%. We don't know if that will be a graduated rate or that's a flat. So if it's not graduated, it might be worse off for some people.
How exciting for you. How exciting.
This is the thing CPAs love. It's like, change, how do we do this? Question here and then we'll come to Greg.
What's the structure for holding properties so that you protect privacy of who actually owns the property? What's that structure?
Depends where you are. In California, it's more tricky because you have to file something called a statement of information with the state, which in Delaware, for example, Nevada, you don't have. So if you're in California, you have to do it through things like forming trusts, forming entities, and not having your personal name. Or, for example, one particular thing that I always tell my clients is, when you file your trust deed, don't put your name and your home address on it because that's a public record. Send it to us, put someone's name and have it returned to somewhere that doesn't have your name on it or your address. Same with the statement of information. It's a little bit more tricky because you're required to list, for example, the manager and the officers. So you can't actually be a manager and not list your name. So we sometimes form other entities, or that's one other reason for forming an entity out of state. Now, again, if you're then investing in doing a property in California, you kind of have to do it anyway. So it really just depends on your situation and how severe you want your privacy protection.
How many hoops you want to jump through to keep your name off the public record. But there are ways to do it.
You pay him to have a BVI trust with 3 entities. So I mean, some people go through those extremes, but there are obvious things like don't put your name on the trust deed that you can do that'll make it harder.
And then you can always scare people by making your LLC name
Thank you. Where's my limit?
Pro Bono Attorneys LLC or something like that, or Pro Bono Attorneys Trust, to scare them off so they don't come and sue you and things like that. So, but, back to, I want to get back to the flipping aspect of things, because I think a lot of the people here want to understand that piece of that from a liability protection standpoint and an estate planning standpoint. If you're running a flip business and you want to do proper estate planning for that business and still retain control but have the estate planning in place, how is that? What does that look like from an estate planning, like putting it into the trust? And so you have an S corp that you're flipping properties out of, and you go through and make the ownership of the S corp the trust. And how do you can you still be the manager of that, or how does that work?
Yeah. So I would say if you were an S corp, from an asset protection standpoint, usually it's preferable if you can have it be an LLC. Have it be an LLC. You can always elect S corp taxation status, and the owner of the S corp would then be your living trust, right? So then what happens is, if anything happens to you, your S corp it's not owned by you, right? If you're no longer around, then it's held by your trust. Your trust continues to exist, and your successor trustee would then step in and continue to manage everything. It's fairly straightforward as far as that goes. And then if you have other partners, then your trust would own your portion, and presumably your partners would then own their portions, either individually or in a trust.
And that's basically, you're not really getting any liability protection from the trust, right, like we talked about. But what happens if you want that liability protection from a trust, and you want it to, is there a way to structure that for an estate plan so that you are taking all that liability away from yourself in that case?
Well, so what you would be doing by forming the LLC, you are creating that barrier between the business liability of flipping from attaching to your other assets.
Okay.
Although, if you're the only person that's doing it, there's a possibility that you could still be named personally for acts that you're doing within the management of that LLC. Because there would still be some protection, but there's a possibility that a creditor could still.
And if that happens, I know there's trust like irrevocable irrevocable trust and things like that. Can you take away your own personal liability by doing that? I guess if you're still running a business, you still have personal.
There's always that potential
liability,
of personally acting within the business.
And if you're going through and say you have a rental property that's not in there, or not in an LLC or something like that, and you have it in a trust, can you then take away liability from yourself by doing a irrevocable trust in that case?
Yes. Okay. So in that situation, right, when you're acting in the business, there's always that possibility that you might be personally named, right? Or that you might be personally liable for gross negligence, or for acting recklessly, or causing undue harm by doing something improper in your personal capacity. However, that's why it's important not just to have your corporation or your LLC in which you run the business, because the way you deal with that is then you structure your other assets, right? The other things that you would want protected, you would want to place in other entities that would provide greater protection. And one of those entities would be an irrevocable trust, which is a trust that you don't have the ability to just change whenever you want. So you've designed it to limit your ability to make changes to the trust or to undo the trust. So that way, when you transfer these assets to that irrevocable trust, you don't retain that string to be able to pull it back into your name, right? Because that's the issue with the revocable trust. If you retain the right to revoke it, you can pull it all back into your name and subject to your creditors. If you don't retain the right to revoke it, then what happens is you've essentially given it away. It's like if I gave Matt $100 and tomorrow I get into a car accident, then what happens is a creditor says, hey, we want that $100. Well, tough cookies, I already gave it away, right? So that's the argument by giving it to an irrevocable trust.
Is there any other reason to open an irrevocable trust? What are the reasons why people do that?
Yeah, so usually when people create irrevocable trusts, it's usually to accomplish a couple of things. One is asset protection. They don't want those assets to be exposed to their creditors. The other one is tax planning. So it's a way to pass more on to your loved ones without being subject to taxes. With regards to the irrevocable trust, right, you can easily do it for other people. Like, for instance, your kids. You want to set up an irrevocable trust and say, hey, I'm going to use my annual gift tax exemption and start giving away assets to my kids now, but I don't want them to control it until they're old enough, right? You might use an irrevocable trust that way, and that provides really powerful asset protection. But if you set up an irrevocable trust for yourself, California says we don't like that. So California says if you set up an irrevocable trust and everything's held for your benefit and the trustee is obligated to use those assets for your benefit, California says we don't recognize those as a matter of public policy. We're going to set those aside. But guess what? Other states, as a matter of public policy, really like them. For instance, Nevada. So Nevada will allow you to set up, if you meet certain criteria, to set up an irrevocable trust for the benefit of yourself. So let's say you have $1 million in a brokerage account. You might say, okay, I'm going to put this in an irrevocable trust in Nevada because I'm running this flip business. I don't want to, that's my rainy day fund. If the poop hits the fan, I want to make sure that money's there for me, right? Now, if somebody sues you here in California, a California judge may say, look, you've got this irrevocable trust for the benefit of yourself. We don't recognize them, so we're going to issue a judgment against you. But now, in order to get that judgment enforced, they have to go to Nevada. So in Nevada, what happens is they try to compel a Nevada trustee to make the distribution. Well, the Nevada judge is going to say, well, as a matter of public policy, we in Nevada recognize these types of trusts. So what you do is you create a conflict of laws. So Nevada's laws, and it's like, what is it, like Godzilla versus like Mothra, right? So it creates a lot of uncertainty for the creditor. So the more uncertain you can make a creditor's ability to get a judgment and to collect on that judgment, all that creates settlement value. So it basically forces them to the bargaining table to negotiate on your terms rather than them dictating terms to you. And usually that means you pay out a lot less money, it's a lot less time, and a lot less headache.
And then from a legal liability perspective, Peter, can you talk about, on the flip side, when people are flipping, what are the liabilities they're trying to protect against? What are the major risks that can happen from flipping houses that you can get sued for?
There's lots of things. I mean, everything from your contractor cutting off his arm, depending on how quickly you do your flips, not knowing enough about the property as the seller, loan issues if you're doing several flips and the market turns and you've got 6 deals going, although oftentimes your loan will need to be guaranteed. There's all kinds of things. Your 6 months, or I don't know how long flips take. 3 months into a project, there's a pool in the back. Kids come in, they climb over your fence or skateboarding. They break their arm, and you didn't have a large enough barrier to keep kids off. And it's a hazard.
It's an attractive nuisance.
That's the word I was looking for. Hate it towards. So. There's all kinds of things and reasons that, meanwhile, you've got your rental properties that are just nicely sitting there generating cash flow, which hopefully are in a separate, business and entity structure from your flipping business. So when this attractive nuisance comes along and, some high net worth Beverly Hills person, kid thought he was cool skateboarding in Venice and he breaks his leg or his arm or both, comes after you, all of that stuff is safe over there, and you have your S corp or other entity in insurance, and so you've separated those two businesses.
And keep in mind, guys, the first line of defense is insurance. The second line of defense is your legal entity in that case. So, having proper liability insurance that insures you for flips specifically. If you have a renter policy and you're in the middle of a flip or you're in the middle of a renovation, they're not going to cover you. Most rental policies want to make sure that it's going to be rented within 30 days. And if you have
that's a liability.
Right.
You tell them you're going to live there and you
renovate it and flip it and do the wrong thing and have the wrong. If you have a homeowner policy and it's a renter, it's a rental. That could be a reason why an insurance company isn't going to pay for it. If you're doing construction work and don't have workers' compensation insurance and your contractor slips and falls or gets hurt, you could have an issue there as well. There's a lot of different factors that flow into it, which, in my opinion, makes it really, really important to form an entity for flipping, just because of all the additional liability that goes into the construction aspect of that part of the business. And a vacant property being more risky for liability purposes than a rental.
You can call your insurance company when you have your rental go vacant, I understand.
After 30 days, you need to, because they allow you a 30-day window most of the time. If it's vacant for longer than 30 days, there's insurance companies that I use, because we do so many of them, where we get blanket policies, and there's a construction clause in there that basically indicates that they know that we are renovating first, and we have that insurance covered as well, that liability covered too, on top of it.
Quick note about insurance and asset protection planning. So insurance is kind of like the gateway asset protection tool. I mean, we're talking about
right.
So insurance is really, really important, right? But it's not the only thing. So a lot of times people think, I have a $1 million umbrella policy, I can sleep well at night. The problem is your umbrella policy doesn't cover everything. In fact, it doesn't cover lots of things. And there are also limits to the policy, right? You have a $1 million policy and a $3 million loss, you still have a $2 million problem, right? So it works really well with a lot of the asset protection entities that we structure, because essentially, think of it like you're going camping. When you go camping, you don't put your igloo cooler in the tent, right? You usually put it out like on a park picnic bench or in a tree somewhere, right? Because if a bear comes sniffing around for the bologna in the cooler, you don't want them coming into the tent. That's the same thing as insurance. Insurance kind of acts as the low-hanging fruit that you drive a predator towards, right? And so the more difficult it is for them to break into your stuff, the more you can drive them away towards the insurance. What it also does is it also provides liquidity in case you actually harm somebody, right? A lot of times people assume, hey, when you're doing asset protection planning, you build this castle, you sit up in the tower, and you laugh at people, right? You get in a car accident, you hurt somebody, you're laughing at them. And that's not true. We're humans, right? We have a moral obligation, a karmic obligation, I guess, to make right when we do something, when we harm somebody. And so the insurance provides that. And the asset protection allows us to do it on our terms rather than somebody else dictating those terms to us.
And I think it's important, too. A lot of people think that insurance is the cover-all, and insurance companies specifically exclude everything that they've had to pay claims on in the past. So you're looking at dog bite coverage, domestic violence coverage, like all these little things that they've had to pay for, and now they're like, nope, they're excluded. So you want to make sure those things are covered and read those exclusions in your policy.
And make sure you have a good broker or an agent that's really looking out.
And it's very dependent on the type of business you're running. Like, for example, in the short-term rental business, most typical landlord policies exclude short-term rentals. So you have to have a specific inclusion or taking away that exclusion from that policy, and have a rider for that in your policy. And so in addition to that, you want loss of rents coverage and things like that. Like, we go through and sublease properties when we're doing the short-term rentals, and so we go through and we want loss of rents coverage. We want to make sure the owner's covered for the building if there's a fire, because what happens if I go get a normal policy, just for like a renter's policy on my property if I'm renting it, and the homeowner has their normal policy, and I'm doing a short-term rental out of it, and they allowed me to sublease it, legally. But, if there's a fire, my renter's coverage may not cover it because it's a short-term rental. It's a different type of policy. Their policy may not cover it because they specifically exclude short-term rentals. So there's intricacies here with the different types that you do, and you want to have an insurance agent that really knows that well. So, question over here.
If you're doing like ILs or long-term rentals, can you have you guys typically review the leases then and cross reference it against the insurance policy to help out?
We certainly review leases. I don't typically review insurance policies. I can if clients ask, but they're pretty heavy and they're pretty intensive, and normally clients don't want to pay me because they rely on their insurance agent. But we certainly can. I will say I'm not an insurance expert.
Are there lawyers out there that...
Yes, there are lawyers out there.
There's a lawyer for everything.
There are lawyers out there, insurance experts.
He says it with a straight face.
And I think, by the way, that's, in all of this, it's not like, hey, I formed my LLC, now everything's done, or I did my asset, almost every transaction has a CPA, a tax lawyer, an asset protection. You need to do all of these things, and even when you form your LLC, then you need to say, okay, I need to keep my corporate formalities, I need to have separate bank accounts, so, you need to kind of be thinking about all of these things and all of us in tandem with each other. But there certainly are, to go back to your question, people who are insurance liability attorney, whatever they're called.
There's something funny about it. You mentioned making sure that it's a good insurance agent, and we had a bad one apparently because we were asking him for one of our rental properties. So make sure this rental property, the insurance covers rental properties. Oh yeah. Okay, well send us the policy, and then we flipped to page 3 or 4, wherever the exclusions are, and it clearly states that rental properties are excluded. What the hell? They told me it was included.
I had the same thing. Not all insurance agents are created equal. The very first agent I had, they gave me what's called a DP1 policy, which is a homeowner's policy, even though I lived in California and was investing out of state. And I'm like, it's obviously a rental property. And, I was too new and didn't know, and there was vandalism, and it cost me $5,000, and I had to cover it out of pocket. He was immediately fired, and now you really need what's called a DP3 policy, which is a rental policy associated with your property. So, and not all policies are created equal either. So there's what's called replacement cost coverage, where they will rebuild your property, and depreciated value coverage, where they say you've owned it for 10 years, it's old now, therefore it's not worth what you paid for it anymore, it's worth less because of that, and they put their depreciation calculation to that as well. And there's certain policies that will give you builder grade or building code upgrades, where if there's a fire and there's a bunch of code changes for that property, then they will rebuild it up to current code and things like that. So, question over here.
But the premiums might be valuable.
Say it again.
You still pay the same premium, you get a lower value back because of 10 years.
Many times on the depreciation, the insurance companies that we see, a lot of the depreciated value coverages can be higher for some reason. I don't know why, but they just, certain companies are higher than others, and you want to go to a specialist insurance agent that's been around for 25 plus years, that knows their stuff, knows how to do this really, really well.
It's nice to have a broker too, rather than an agent.
Right. We have a broker that he goes out to all these other big companies and specifically structures insurance programs for the type of activity we're doing. So, just as an example, in the short-term rental aspect of things, you have a whole nother slew of issues that come up, because what happens if you have a single family home that you're doing a short-term rental out of versus maybe a commercial property, and the city says that that's a commercial activity and therefore deemed illegal? That's an out now for the insurance company to get out of, paying. And so this could happen with all types of different income sources and asset classes and things like that you want to be careful of. So learning how that insurance works and having a really good broker is important, but also the entity structuring with regard to the liability protection and having your attorney on that team and your CPAs on that team to be able to go through and say, look, that may make sense from a legal liability standpoint or an insurance insurance perspective, but maybe not on a tax perspective. Maybe there's a slightly different variation that might work for the legal aspect too, that also works for the tax planning purposes too on top of that.
And it's nice when everybody talks too.
Well, yeah, and that's the key, right? So I'd rather pay for the service and get the right advice than, I've paid attorneys way too much money in the past for bad advice in the past, and it happens. Same thing with CPAs in the past, and internet marketing people and everybody else in the world. They will not put you on the first page of Google, I promise you. So, as a closing, I want to just touch on the tax aspects of owning rental property and what that can do for you from a tax mitigation standpoint, because there's certain strategies you can use, and I want to touch on the depreciation just briefly. Are there ways? What are the limitations on depreciation? How is it normally calculated, and how can you get more of it? Yeah, I have 3 questions in one. I'm going to take another half an hour. No, in 5 minutes, guys.
I think those of you investing in rental properties. Obviously, the first goal is that you're generating cash flow positive property. You're buying, investing in cash flow positive property. So the question is, well, how do for tax purposes, how do I get that number from a positive number down to 0 on paper or even a loss, right? And one of the ways you do that is with depreciation. Now, depreciation is just a fancy term for the IRS says you went out and bought a property, and unlike a stock, you got to buy a stock, you don't get to write off the cost of the stock over time. You only get to write it off when you actually sell the stock down the road. But with a rental property, the IRS will say you get to write off, essentially the purchase price of your property over time to kind of recover that cost that you spent. Now the benefit is, one of the huge benefits is that it's based on the purchase price, not necessarily your down payment. So you could do 20% down payment. You're buying a $500,000 property, you put $100,000 down. But the depreciation is going to start by being calculated off of $500,000, not just $100,000.
Oh, the building portion.
Well, the building portion, right? So yeah, you take your $500,000, you split building and land and all that stuff. But so that's a huge benefit. Obviously, if you're only out of pocket $100,000, but over time you can write off maybe up to $400,000 or $500,000. Mm-hmm. Now, generally for residential rental properties, your depreciation is calculated over 27.5 years. Commercial properties is 39. So you're right, again, you're writing it off over 27.5 years. But there's ways that you can write off certain aspects of the property over 5 years or 7 or 15.
New water heater, new roof.
Water heater, flooring, cabinets, fixtures, lighting, outside stuff like asphalt, sidewalks, fences. There's lots of things that you can write off sooner than 27.5 years. Now, over time, you're going to get the same amount of depreciation, but it's how do we take more of it now, right? How do we get more of a deduction now so that we can offset our taxes now and then reinvest that savings to buy more properties? So
what if I went through and bought 10 single-family homes or a giant apartment complex or something like that where the depreciation was $100,000 a year and I was able to get it to that point and it flows through to my personal return? Are there limitations? Can I take all of that right now, or is there limitations to that?
Yeah, so there are limitations on, the question is if you generate a loss in your rental properties, can you use that loss to offset your other income? You can always use your loss on a rental property to offset rental income from another property. But if you combine them all and you get to a loss, can we use that? The IRS says yes, you can use you can deduct up a net $25,000 loss. But once your income reaches, starting at $100,000 and reaches $150,000, that $25,000 cap comes down to 0.
But you get to carry that over, right?
Yeah, you do get to carry it over. You don't lose it. It's a benefit down the road. So that is one limitation, that if you're not doing real estate as your full-time day-to-day business, you're probably going to run into these limitations if you're generating losses on your rental properties.
But if you are a full-time real estate investor, you can take all of it as long as you prove it, right?
Right. There's ways in the tax world that you can be what's called a real estate professional. If you're generating losses on your rentals, you can use that on an unlimited basis in the current year to offset other W-2, maybe other business income you have, which is huge, obviously. If you have a $40,000 rental loss and you want to offset other income and your tax rate's 40%, I mean, that's a huge savings that you can use that savings to, reinvest in more properties or whatever.
And there's ways to never pay tax if you have like a Roth 401k or something like that, and you want to buy a property inside of that 401k. You don't get the depreciation benefits, but you're also not paying any tax on it either. So you can self-direct your own money into real estate in a lot of different ways. There can be some taxes associated with that as well. If you're borrowing money inside of your IRA or things like that, or if you're dealing with a traditional IRA versus a Roth, then you have to pay it down the line. But if you're borrowing money inside of an IRA, say I have a $100,000 house and I put down $30,000 and borrow $70,000. How do the taxes work with that type of a situation inside of an IRA?
Well, so the IRS allows your retirement account to invest in leveraged real estate, okay, which is Matt's example, $30,000 down, $70,000 debt. So that is allowed by the IRS. However, the IRS does have a tax. It's called unrelated debt financing tax. And that basically says to the extent that you generate taxable income, so the income is from leverage, okay, meaning not all your retirement money, then the leverage portion could potentially be subject to this debt financing tax. The rate is pretty high. It's roughly upwards of 39% currently. So for a lot of people, it's higher than what they would normally pay individually. Practically speaking, though, what we typically see is that even though that rule exists, most people do not end up paying taxes because that 39% is applied on taxable income. And we were just talking about with rental properties, you get to take depreciation, you have write-offs. So if you have sufficient deductions against that rental income, 39% applied against zero taxable income is still no taxes due. Okay. There are other ways around this 39% tax. Definitely something that you want to talk with your tax advisor about if you're interested in using your retirement money to invest in leveraged real estate.
And then what about flipping houses inside your own IRA?
We don't recommend that ever. When you're flipping property inside of a retirement account, that's considered an active business, and the IRS has a similar tax. It's called unrelated business income tax. Again, 39% tax rate. Essentially, the IRS wants your retirement money to be passive investors. So that means rental income, interest income from note investments. Those are typically what we recommend. So we have clients who do fix and flip, and they fund $50,000 or $100,000 in the retirement account every year to reduce taxable income. And they really want to turn around and use that money in flips, right? Naturally, that's what they do. So one of the potential strategies around that is, well, instead of using that money to flip, maybe use that money to be a lender on someone else's flip. So that instead of generating flip income, your retirement is generating interest income because you're a lender on someone else's deal.
So go lend money to your brother that is going to go flip and charge him 30% and 15 points, and it may not be.
I don't know if the attorneys
Is there or
have
not?
that.
Oh yeah, I forgot about the usury laws. I forgot about that. Yeah. So
Usury laws and related person self-directed IRA.
Well, no.
Other than that,
actually, your brother's not a disqualified party. Lineal descendants, parents, and kids are disqualified parties.
Uh-oh.
Brothers, sisters, aunts, uncles, and the like are not disqualified parties. But closely held business relationships can be. So I'm in business with my brother, so I probably have a hard time going through and lending to him for my own self-directed IRA because in that actual transaction, it might be arm's length, but in reality, the perception is that we're closely held business partners, and so it could be an issue in that case. So, if you're doing these creative strategies inside your IRA, definitely talk to your CPA. If you're lending at above usury rates, talk to your attorney.
I think if anything, you can take anything away from tonight's talk. Anything we've talked about is this is not do it yourself, right? This is get your advisors involved, talk to your teammates,
find good people.
Yeah, sure. What was your?
So while we're talking about lineal descendants, I don't know if you'd like to briefly touch on property taxes and things to be aware of there. So so you guys are all familiar with property taxes, right? Anytime title changes,
you guys are
the
paying
county wants to
taxes.
reassess, right?
In California, yeah.
In California, so we're all familiar with Prop 13, right? Your property taxes can only go up maximum 2% per year over time. but your California real estate tends to appreciate at a greater value than that, right? So if you've owned property for a long time, your property tax base is usually going to be much lower than the fair market value of the property. And so for a lot of families, that's a huge deal, right? We want to pass on this property tax basis and keep it in the family. And so one important thing to think about is when you're planning for these sorts of things is understanding the various exceptions to reassessment. So when you're passing assets down to from parent to child, either way, if you're buying, selling, or gifting between parent and child, that's an exempt exclusion. So if you pass on assets to your children, a certain portion of that is not going to be reassessed for property taxes. If there are also exemptions between grandparent and grandchild, if the intervening parent has passed away, you can also get exemptions as well. So when you're planning for your estate, you may want to be very careful in structuring how you're passing these assets down to the kids. Because let's say we have two brothers, one of them wants the house and the other one doesn't. You probably don't want to leave it to them 50-50, right? Because if you leave it to them 50-50, one buys the other one out, half that property is going to get reassessed for property taxes, right?
I've experienced otherwise.
Have you?
Yes, as a lender and seeing the whole 6-month IRS episode.
Okay.
So what happened was the parents died. The kids all had access to this tax benefit. For the loan purpose, we had to have a brother on the loan with the other brother. The other brother stepped out, and it did not create a taxable episode for the other brother. And the wife stepped in on top of that.
Purchase? Is that
It's not a purchase. There's
both
no money.
brothers on the loan?
No money moved away. So in other words, there are two of these. Smith and Smith were on the title to the property.
Two brothers were on the...
Yes, Smith and Smith, and one brother was moved off, and later on the wife came in, and she was able to qualify for the loan and had no tax consequence, and it was a bit of a hassle.
But it wasn't a sale, right? It was
There's
not
no
an
money
actual
changed
sale. They
hands.
just changed title.
Well, it doesn't matter though.
Yeah,
because
because
it should have been reassessed, but it may have just been a situation where the county just missed
It got kicked upstairs, and the Smith won.
Okay.
It right here down the street on Willow.
Interesting.
We had to go in and see the.
I think that's a rarity, though,
supervisor.
comparatively to.
Yeah, because it definitely, I can guarantee you it's happened the other way too. But
Yes, they tried to do it the other way 7 years ago. So
here's the and the counties have been more aggressive in the last, let's just say, 3 years in trying to shake the tree. But in that situation, you might instead say, hey, brother one who wants the house, give them the house, offset it with other assets to the other brother, and then you're.
I think they recognize it as an accommodative lending relationship. I think that's how it panned out. I can't recall. It was a long time ago.
We can discuss it afterwards.
With that topic, I think we're out of time. We're at 9:20 right now, so I'd like to thank everybody for coming, and everybody give a round of applause for the panel.